This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
Thank you for joining me today as we have another big lesson coming out of the 3 bank failures from last week, not the least of which, of course, is Silicon Valley Bank, second largest in the country. I hope you enjoyed Monday's episode. I got a lot of great feedback on that episode, so thank you for checking it out on YouTube. And thank you for your comments. I really love your comments. I endeavor to read and even respond to all of them. I was responding to them last night as they were coming in, so please keep it up. We love your comments. We love your feedback. We love your thoughts on this situation. But what is the other big lesson coming out of this? It is not just the usual things, right? To be concerned about the stability of the banking system, to be concerned about all of this fraud that goes on with the banksters and the elite class and the Wall Street folks. But it is also a lesson to come back to my old content. And hopefully you're listening to all the Flashback Friday episodes. We had Dr. Ron Paul on last week for Flashback Friday. But one particular thing in this old content of mine, going way back to 2004, and that is my 10 commandments of successful investing. And there is one that stands out above all others in the midst of this banking crisis. Because what we learned, and are learning more, I'm sure there will be much more revealed, but what we learned is that we learned that Silicon Valley Bank bonused all their employees the day the bank was collapsing. Literally, as depositors couldn't get their money, they were giving bonuses to the employees. And the president took out about, $3.7 million less than 2 weeks ago. So that big lesson is commandment number 3, thou shalt maintain control. Be a direct investor. Imagine if you were an investor in these banks, right? Imagine if you're an investor in any other asset class, and I've profiled it so many times for you. The fraud, just the disgusting lack of ethics in today's world, and especially in the financial system, where all of these elites are just skimming the money off the top. And many times they've got the law on their side. It's just totally legal to do what they do. So be a direct investor, buy assets that you control to whatever extent possible. I get it that, that may not be your whole portfolio, but if you want to get ripped off less and have more control, be a direct investor to whatever extent you're willing to do. It is a little bit more responsibility. We make that responsibility a lot easier for you through our network, but you own assets, you control them, you decide what to buy, where to buy, when to buy, how much to pay, who to rent it to, how much to rent it for, when to refinance it, how to structure the deal. I mean, it's just so much better to be in control. Now, of course, there has been a litany of discussion over the past little less than a year. Well, there's always this discussion about the real estate market and is it in for a correction? And we've discussed this ad nauseum on the show, but I just got to share with you the latest inventory statistics. And inventory keeps declining. Yes, all the doom and gloomers kept saying that, oh boy, inventory, it's going to be skyrocketing this time of year. There's so many deals that are falling through. There's so many people that are going to be in tough shape, the layoffs, the this, that, and the other thing. But inventory keeps declining. And of course, you know why. I'll show you a chart on that in just a moment. But look at this chart. If you're watching on video, we're down to 412,000. Inventory still falling, literally as of just a few days ago. This is totally current information. So remember, my sink metaphor is the one you want to think of when you think of the market. You want to think the inventory coming onto the market, new listings, that's the faucet. The existing inventory, how much is already for sale? That's the water in the sink. And then the drain, that represents the buyers or the absorption rate, the properties that are being taken off the market because someone purchased them. So it's an odd situation, what you've got right now. You've got only a trickle of inventory, a trickle of water coming out of the faucet. You've got only 40% of the sink is full because our inventory is dramatically low. It's only about 40% or even less than that of where it needs to be in a quote unquote normal market. And that kind of assumes that normal is the sink being full in my metaphor here. Then you've got the drain that is a little bit plugged up because sales are down in many areas by as much as 35%, 20 to 35%. So lower sales volume, but lower inventory. Those two usually do not go together. Those two are usually opposite. They're non-correlating indicators, but that's exactly what we've got right now because everybody is hoarding. They are holding on to their house. Why would they trade their 3% mortgage for a 6 or even 7% mortgage? They're not going to sell that house. They're going to keep it. And as we know, 25% of the country almost has a mortgage below 3%, and 65% of the country has a mortgage below 4%, and over 40% of the country has no mortgage at all. So this is why we have an incredibly low foreclosure rate. We have almost no distress in the market. And as I always say, if you want to have a real estate crash, you got to have distressed sellers. Now, remember, linear, cyclical, and hybrid markets act very differently when it comes to prices. So invest in the good linear markets. Avoid the trophy markets. Avoid the West Coast of the United States. Avoid the expensive Northeastern markets. And I would normally say avoid South Florida, where I live. But Florida gets a little bit of a pass because everybody's moving to Florida. So that is kind of papering over the cyclical markets in Florida to a pretty good extent. And we don't really care because we're not investing in those markets anyway. We're investing in good, solid, linear markets where properties make sense the day you buy them. Okay, look, I'm going to get bored of the banking subject pretty fast unless we have some more sensational banking news, which we probably will have some more news. So I think that's coming. But one more thing on Silicon Valley Bank, Silvergate, and Signature Bank, and that is today's show because I reached out right away on Sunday to get a deep dive expert, to bring you an expert who used to be in this business and is now a consultant. So he has some really deep information for you. And let's take a deep dive and let's get some new intel on the banking crisis right now. And then next week, we're planning to return to our regularly scheduled programming. So here's our guest as we take a deep look at the banking situation. It is my pleasure to welcome Alfonso Peccatiello to the show. He is the founder of the Macro Compass, and we are going to take a deep dive into the banking system today and talk about what you can do to be aware, to protect yourself, and how you should dictate your investment strategy based on the absolute craziness that's going on in the world. I think it's going to be a pretty interesting and chaotic year. Alfonso, welcome. How are you?
Jason, very nice to be here. I'm good. How are you doing?
It's good to have you. And you're coming to us from the Netherlands, right?
Yes, today, yes. I don't know if by 5 words already people understand I'm Italian, but most of my time I spend in Italy this time. I'm talking from the Netherlands.
Fantastic. Well, it's good to have you. Thanks for coming on so quickly. As I mentioned on a prior episode, I've been following you on Twitter and you've got some great research and some great tweets. So we appreciate you coming on. Of course, we had 3 bank failures last week. This is getting scary, but is this a hint that there is concern about contagion or overall collapse? Of course, there's a lot of sensationalism out there, a lot of clickbait, and, fear sells. We all know that. But tell us where you think we are.
So, Jason, let me say that I think small regional banks here have a problem. the larger banking system, a bit less so. Let me try and explain. First of all, some background. Before running the Macro Compass, I ran an investment portfolio, several $1 billion worth, for a large European bank. So I was exactly, in the belly of the beast,
right?
Let's say. So I'm lucky enough to have some first-hand experience of how this works and what's going on. Now, shall we try to make our audience understand what really happened with Silicon Valley Bank and these three banks going down? Yep. They've probably read a lot, but let me try to see if I can summarize it for them in a concise way, because that's where we start to understand whether this is a systemic risk or not. The reason why banks have all these bonds on their balance sheet in the first place, you have read about this securities portfolio, is because of regulation. And this LCR you see over here is something called liquidity coverage ratio. This was introduced after the great financial crisis to make sure that
so
banks...
was this part of Dodd-Frank then?
No, it comes a bit later than that.
Okay.
It's a set of regulatory rules which was implemented a bit later. Okay. But it was basically designed after the great financial crisis. And what it does is it forces banks to own this, a stock of high quality liquid assets, which should be at least as big as the net cash outflow over 30 days. What the denominator of this ratio is a stress. The regulator stresses how many deposits can flow away from a bank over a 30-day period. And then it says to banks, you should own as many liquid assets at least to match this stress scenario. Now, the question is, what is a liquid asset? Now, very simple. If you take deposits away from the bank, what do you want? You want cash. That's what you want, right? So you want something super, super liquid on the other side to meet this outflow. So as you can see, there are different levels that qualify for HQLA, high quality liquid assets. And okay, coins and banknotes, that's very simple. And then you have central bank reserves. So if you have money at the Fed, you can just take it away and service your deposit outflows. That's very simple to understand. And then you have securities from sovereigns. Okay, those are treasury bonds, right? So the regulator says, if you own treasury bonds, I will consider them as liquid as cash, basically, because I will consider that you can always sell them at a reasonable price, raise the cash and pay the depositors away. You can also see in red here, I put some other interesting boxes, because with a small haircut, you can have corporate bonds and residential mortgage-backed securities as part of your high-quality liquid asset portfolio. So what bank did, Jason, is they started buying bonds. The regulator forced them to own bonds. And let me give you a perspective on how many of these bonds are we talking about. Banks today need to own about 15-20% of their balance sheet at least in these securities. So it's some trillions of bonds out there being held by banks because of this very reason. Those are treasury bonds, mortgage-backed security, commercial-backed securities, corporate bonds. Now, Silicon Valley Bank had a peculiar problem, and you can see it being depicted on the bottom right of this chart. What they had is a very low amount of sticky retail deposits. Those are the deposits of mom and pop. They go to the bank and they very rarely use which bank. Let's be honest. How many times have you switched bank as a retail depositor? You don't do that very, very often, right? So if you have a lot of these, you are on the top of this chart, you have a low risk deposit base. It's well diversified. It's a lot of people. It's not easy for them to take money off the bank very quickly. Silicon Valley Bank was at the very bottom of this chart. They had a lot of money coming in from tech, VCs, IPOs. They had a lot of this tech vibe, 2020, 2021, cash-rich corporates and families depositing money at their place. Mostly tech corporates accounts. The problem with that is that it's a very concentrated funding base. It can just disappear very quickly. It's a lot of high tickets, big accounts, rather than a large number of small retail accounts that are more diversified and more sticky. The other thing that you need to know about Silicon Valley Bank is that their asset side, their balance sheet size was below $250 billion. And why do I say that? Because if you're below $250 billion, the regulation that you're subject to in the US is much, much laxer. You are not subject to very tight stress test, regulatory standards, the diversified funding ratio. You are not subject to any of this.
So $250 billion is the mark where the bank becomes more or less highly regulated. So yes. This is why potentially these regional banks that you referred to earlier are at higher risk of failure, right?
That is correct, because the level of regulation that is applied to banks below $250 billion It's much less than large systemically important banks. So for instance, the liquidity coverage ratio here is not binding for a small bank, which means they can buy bonds still, they're free to do so. But as you can see here, if you are a large bank subject to this ratio, you can have only 15% of your HQLA, of your bond investments in mortgage-backed securities. Silicon Valley Bank didn't have this constraint, for example. So what they ended up doing is build a completely missized, mismanaged portfolio and match that against a very concentrated funding base. That's a cocktail for disaster because you have depositors that can flee away very rapidly.
Yeah.
And you have a portfolio which is completely mismanaged because the regulation doesn't force you to really be close and watch closely what you're doing. Wow. Jason, I'm going to say one more thing and then I'm going to stop and let you ask a question. Sure. Let's have a look for a second at this portfolio that they had. This is just ridiculous. First of all, the size, $120 billion. I mean, it's more than half of their balance sheet.
Yeah, 57% actually, right?
I mean, I just said before, normally banks own 15 to 20% of bonds. Right. These guys owned 57% of their portfolio into bonds.
It makes you wonder, Alf, why were they so bullish on mortgage-backed securities? I mean...
No, and I'm going to go into the moral hazard part here, Jason. So what did they do is they bought $57 billion, more actually, $70 billion of mortgage-backed securities. You can see them here in the box in red. MBS, residential MBS, it's roughly $70 billion. And commercial-backed securities on top of that, $91 billion of mortgage-backed securities. Wow. It's a ridiculous amount, which you cannot own. Again, I want to stress that much if you're subject to this. You can only own 15% of your HQLA into these bonds. They ended up owning 91 out of 120. I mean, this is
my gosh, wow.
This is a ridiculous amount. Yeah. But this is possible because regulation wasn't that tight on a bank below $250 billion. The trick here is, to answer your question, why were they so bullish? Mm-hmm. It's not about being bullish on mortgage-backed securities. It's about generating some return. So they don't have regulatory scrutiny. Remember that. Every bank wants to make money, Jason. So what they did in 2021, 2022 is they attracted a lot of deposits from these tech-rich IPO'd companies.
Right.
Deposits are coming in. Your liabilities go up. Also, your assets will go up. That's how a balance sheet works, right? But if you take money in and you do nothing with it, your assets are reserves at the Federal Reserve.
Right.
That's what they are, just idle reserves at the Fed. And do you remember what the rates were on these reserves in 2021? 0%.
Right.
The Fed wasn't raising rates. They were promising to keep rates at zero for a very long period of time. Yep. It seems like a while ago, but that was the case. If you're a bank and you want to make money in your assets, what do? If you can make loans, you do loans. Nice. Otherwise, you go and buy some bonds. Mortgage-backed securities offered a yield, which back then was about 1.6, 1.7%, with a duration of about 10 years, roughly, about 10 years.
So for them to like that deal, they would have to believe that interest rates were going to stay incredibly low for the next 10 years. I mean, that's just crazy. Let's chat about that. When banks buy all these bonds and they are forced by regulation, so I'm talking about a big bank now. So JP Morgan, Citigroup, they are subject to tight regulation. Remember, they must buy these bonds. But what they do, Jason, on the other hand, not to take a bet on interest rate, they hedge their interest rate risk. Right. Silicon Valley Bank didn't do that at all. What they did instead is they took all these mortgage-backed securities and parked them into an accounting category, which is called held to maturity. Right, the HIM assets. And that maturity was about 2030, give or take, for most
roughly about that.
So had they not been forced to liquidate those assets, and if they were to hold them to maturity, would they have been okay? I mean, they were still at very low rates.
Correct. What they're trying to do here is the following. They buy a lot of bonds, a disproportionate amount of bonds, mortgage-backed securities as well. They don't hedge the interest rate risk. They park the bonds in held to maturity. What it means is an accounting classification that doesn't show the losses on your bonds anywhere in the financial statements of the bank. Not in the capital position, not in the profit and loss. You can't see them anywhere, Jason.
Yeah.
If you can ride it through until maturity, say 10 years, you will get back your principal at par, and you will have clipped coupons in the meantime, 1.7%, 1.8%. That's what they were trying to engineer. Now, the problem here is really not hedging. It's really twofold. I'm going to share the screen again because there is something interesting I want to show. There is a lot of moral hazard, I think, here at play, because this bank did three things. They bought a ridiculous amount of mortgage-backed securities, just outrageous how big this is. Voluntarily, they chose to park these bonds in an accounting category that hides gains and losses. On top of it, they also decided not to hedge interest rate risk. By the very fact of parking these bonds in held to maturity, from an accounting perspective, it's more difficult to hedge the interest rate risk. So you effectively are choosing voluntarily, Jason, not to hedge your risk.
Right.
You're choosing as a small bank with a regulatory loophole because of your lax regulation to do that. On top of it, the few hedges you had in place in 2021, those are the interest rate swaps. Those are the hedges to protect you against higher interest rate.
Right.
You can see $11 billion held in 2021. It's not much, but it's something.
Okay.
You can see in 2022, it's zero. So you're basically saying they had some hedges in place. They voluntarily took them off. They voluntarily booked a gigantic amount of bonds in held to maturity. And now let me add the cherry on the cake. Their management lobbied very hard for the last 3 to 5 years to try and increase that cap for lax regulatory scrutiny from 250 billion to something more. In case they
thought they were about to go over that.
And then when they saw they couldn't make it, the balance sheet of the bank conveniently remained below that threshold. Uh-huh. I mean, nobody can prove there was moral hazard at play, but what we can say here is two things. The regulatory and accounting landscape for small banks in the US is very lax. It's too lax, because a bank of over $200 billion is not huge, but it's not small either, and can cause a lot of damage, as we are seeing. And second, really, this bank was misrun, mismanaged, and I think there was a decent amount of moral hazard at play here, which is not a good thing.
So with the moral hazard of getting rid of the hedges at the end of, I think you said 2021, right?
Yeah.
So they went basically 15 months with no hedges at all.
Yeah.
That's shocking. Who would have benefited from that? I mean, usually if there's a moral hazard, it's because someone is taking advantage of that. Someone is benefiting. And there is some news coming out about how some of the executives were selling off their shares.
Yes, that's correct.
2 weeks ago. I mean, I think as recently as that. And that's a concern. But we got to go back further than that to answer the hedge question.
So look, who was benefiting from that is the shareholders of the bank, the management, because if nobody finds out, as you correctly said before, Jason, that this is the model of the bank, what the bank is going to end up doing is they're going to clip this coupon. They're going to get the money in from these mortgage-backed securities, 1.7% a year. It's not much, but it's something. On 100 billion, try that. It's quite some money, right? And if nobody finds out, you're going to be looking like a decently profitable bank. Right. While in the meantime, you are not. I mean, you are profitable, but your capital position is at risk. Yeah. So here is the moral hazard. You can use this loophole of a combination of accounting and lax regulation to try and generate returns. And as long as nobody finds out what your business model is, you're going to be fine and clip coupons and clip bonuses, and your investors are going to be happy. But when somebody finds out, your deposit base is highly concentrated, so it takes this little to generate a bank run. Right. So unfortunately, this was exactly what happened.
Yeah. Unbelievable. So here we see that Silicon Valley Bank had this tremendous amount of assets in these various mortgage-backed securities. And of course, the commercial mortgage-backed securities are highly risky because, in the post-COVID era, we all know what happened to, well, at least office real estate. And before that, we all know about the retail apocalypse. So commercial real estate, most sectors of it are in pretty big trouble. But we see a lot of other banks with a decent share of these same types of securities. Yeah. And a lot of people are using this chart to say, hey, look, a lot of is that true fundamentally?
Look, again, we need to make a distinction between small banks and highly regulated banks. So if you take all banks above $250 billion, you will start seeing that their distribution of securities held is very different. So let's take Citigroup or Morgan Stanley, for example. So if you take those, you can see that they generally own, first of all, not a huge amount of bonds, between 15 and 23%, right? It can be 25, it can be 30, but that's roughly the number. I mean, anything above 25 will be, generally speaking, a very, very, very large book. So they are, first of all, they have a book which is much smaller, which makes the problem smaller in the first place, right? Mm-hmm. And then you will see that, of course, they will own some mortgage-backed securities. In some case, they will own, take JP Morgan, great example, 19% securities as percentage of the balance sheet, right? 47% in treasuries. You see that? There you go. 4% in, 4% in similar assets. Mortgage-backed securities, 25%, bit more if you add non-agency, mortgage-backed security, commercial bank. But this percentage is much better distributed. On top of it, I can guarantee, actually, if you go into the annual report of JP Morgan, you will see that they are forced to hedge their interest rate risk much more than a small bank like Silicon Valley Bank was incentivized to do from the Luxor regulation. So the issue is there will be quite some other banks, to be honest, Jason, smaller banks that have used, maybe not to this extent, but they have used the same combination of loopholes in accounting and regulatory treatment to try and do the same business model. Amongst small regional banks, you'll find some other examples of that. The real issue here is that if you're a depositor, because it's a fear mechanism, right? If you're a depositor now, what's your incentive, Jason? You want to take money away from a small bank, for sure. That's a given. And you want to put this money where? In T-bills, in money market funds, government guaranteed, in maybe a large bank. So this is a ripple through effect for small banks. They not only are more vulnerable to these kind of events, but they're really
they're also more vulnerable to the bank run.
Correct.
Right? Yeah, absolutely, especially now. So I wonder if that's playing out with these smaller banks. I don't really know the answer to that. But before we leave this chart, and what I said on my prior episode about this topic is that I think this chart is misleading because what it doesn't tell you is it doesn't tell you the dates they purchased these securities. Yeah. And that matters a lot because they would have different rates on them based on the dates they purchased them, and they would have different maturity dates. So you would have to look at the way the institution dollar cost averaged into those securities, and you would have to figure out the blended rate and the maturity dates of them. Because if it's a hold to maturity asset, if it's maturing soon, you don't have a big problem. But if it's maturing, 7 years from now, as in the case of Silicon Valley Bank, you got a big problem, especially when you're only getting 1.6% on them.
Not only that, but if they hedge the interest rate risk into these treasuries and mortgage-backed securities, you have losses on the bonds, but you will have offsetting gains somewhere else. Right. And in this table, obviously, this isn't shown. I mean, there is much more into that that people need to realize. If you want to give them like a short and sweet two-liner on this, regional banks were always, in general, more susceptible to bank runs because of their business model, because of their smaller nature. Because of Silicon Valley Bank, which was particularly misrun with a decent amount of moral hazard, now we run the risk that there can be further bank runs on regional banks. The Federal Reserve new facility tries to avoid that, but ultimately it's about confidence, right? And the incentive scheme to move your money off a small bank into money market funds, T-bills, or large bank, unfortunately, is there and will remain there.
Yeah. One last thing about what was going on inside of Silicon Valley Bank, but it just astonishes me that they had a lot of attention seemingly to these woke programs. And, I mean, this bank was in an emergency situation and the board knew about it, a year ago. I mean, they knew they had a problem. They had no risk manager. They had inexperienced people in the risk management field that just weren't paying attention to this. And then this person, who a lot of people have talked about at the UK side of it, is worried about all these pride programs and this kind of stuff. I mean, this is extra credit, okay? Social programs. This is not the business of the bank, right? And it just shocks me that they diverted their attention with this kind of stuff.
I'm not going to comment on the human resources policies, but definitely you can comment on the lack of proper risk management. It's scary. To be honest. And people are rightly now asking how many other banks have run so poor risk management approach to their investment portfolios. There might be a few, especially in smaller banks.
Yeah. And just to look at the size of this situation, again, I know you alluded to it a moment ago, but here we look at Washington Mutual. That was $307 billion back in 2008. And I'm guessing this chart is not adjusted for inflation.
It's not. Yeah. I was about to say that.
Right. And so here we're in March of 2023 and Silicon Valley Bank, $209 billion in assets. So that's just interesting. But back in 2008, I think we had about 8,000 or 9,000 banks at the time in the US. 500 of them failed, more than 500 of them. So I wonder how many are at risk now. Are we looking at, a couple hundred banks failing, or is it just going to be a few here and there?
Look, I'm right now, Jason, working to releasing a piece on the Macro Compass that looks exactly at that. Just looks into different banks and what are the vulnerabilities we're talking about? Are these only the small banks? Which small banks are we talking about being the most exposed? Or also the large banks maybe have misrun the risk management? I don't have an answer for that because it takes quite a lot of work to come up with the numbers, but I'm working on that on the Macro Compass.
Yeah, very interesting. That's going to be great. Okay, well, tell us what else you want people to know about this and maybe some of the broader effects. And if there's anything more visually you want to share on your screen.
Yeah. So look, we discussed about bank-run, mismanaged investment portfolios. I think one of the risks that sits together with investors right now is the real estate market. And look, let me try and give you an idea of how I look at the real estate market. First of all, a statistic. Over 85% of housing transactions in the US are backed by a mortgage. So all the anecdotal evidence you hear about cash buyers in the real estate market is anecdotal evidence. Most of the purchases are backed by a mortgage. There is financing involved. So when mortgage rates move from 3% to 7%, that kind of shock, historically speaking, translates into a major loss of affordability, which means new buyers are cut out of the market. They can't afford it. It's very simple. It's just mathematics.
We've definitely been seeing that the last 7-8 months now.
Yeah. And look, this is just pure mathematics. I mean, like there was a chart doing the rounds that showed the median monthly mortgage installment in Atlanta in 2012, which was about, I think, $300 a month. To buy the median priced house in Atlanta, given the mortgage rates back then, you paid about $300 a month. Today, you pay $2,000. Okay, so
you need to adjust that for inflation, obviously.
Yeah, that is correct. But your wage,
but it's still not that much.
I can guarantee that your wage, or I wish for you that your wage has gone up fourfolds from 2012, but
it certainly hasn't. Yeah,
but it hasn't. Yeah. So that means that adjusted for the median income of somebody, you are looking at an increase in unaffordability. Not even looking at 2012, but just looking at 2020, 2021, of something like 50-60%. So the buyers are just cut out of the market for most, right?
So what happens? They're forced to stay in the renter pool, and that puts upward pressure on rents. And we've been seeing rents just skyrocketing. But now there's a lot of multifamily housing that's been delivered. Right. And the multifamily market is starting to see some softening in the rents a bit, or, rent. I don't know if there's really rent deflation yet, but there's definitely disinflation in the multifamily market. And the problem is that's where all the survey data comes from. Very little of it comes from the single family market.
Correct.
A little bit of it does. You've got the Zori, the Zillow Observed Rent Index that's single family. And you've got the big institutional landlords, Invitation Homes, American Homes for Rent, et cetera. But still, that's a small percentage of the rental market for single family homes. So the data is just not really there.
That's correct.
The sample size is not big enough. Okay, so affordability definitely declined, upward pressure on rents. But where do we go from this? See, I think one thing, Alfonso, people are always missing in the affordability discussion is the compared to what question. Mm-hmm. And what I mean by that is that expectations, although they take time, psychology takes a lot of time to adjust, but it has to adjust ultimately. And it would be, this is the metaphor I use for it. If you're moving from, say, Jacksonville, Florida, which is an inexpensive market, to Manhattan, New York, which is an expensive market, $1 million in Jacksonville gets you a beautiful 5,000 square foot, mini mansion. And in New York City, it gets you 650 square foot condo, right? So it's like when you move from an inexpensive place to an expensive place, and certainly people do that. Now they've been kind of going the other direction since they've discovered remote work, and that's been accepted. But don't people just have to adjust their expectations? So it's not like affordability is some fixed idea.
You're right.
It's just that the person downsizes what they can get, and it takes a while. I get it. They're expecting the world, they're expecting everything the way it used to be 2 years ago, but it's just not. And eventually they capitulate and they come to realize this is all we can afford, so we're going to make the best bargain we can as economic actors.
Yes. So you're right. Affordability needs to be compared to your expectations of what are you buying. Nevertheless, I think the first impact where you see such a jump in your monthly mortgage installment,
it's a shocker,
scares a lot of people off, right? They just step off the market, say, look, I'm not going to buy. I can't afford what I wish I could afford, and therefore I'm going to stop out. I'm going to step off, right? Now, what happened is we saw housing sales dropping materially. So, which tells me basically you have a semi-frozen housing market where the buyers don't want to buy at these prices, and the sellers are like, you know what, I have a mortgage rate at 3% for 30 years.
So
I'm good where I am. I'm good where I am.
Yeah.
What actually moves that equilibrium and in which direction? I think the signals we're getting is that we might have to move that equilibrium with lower prices to adjust to the new reality, at least temporarily. I expect house prices to drop quite significantly over the next 12 months. The reason is simple. What moves this equilibrium is either the labor market cracking. If people start to lose their job or lose confidence about having a job, obviously they will have to monetize on some of the money they have locked up in houses, right? They have equity in some houses. They can monetize that if they think they're not going to have an income for the next 2 years because they're unemployed, right? So if the labor market pops, then obviously the direction of travel is lower prices.
How much chance do we have of the labor market popping? I mean, the Fed has been trying to destroy the labor market and they're just not succeeding. And now we might have lower interest rates, or at least no more increases.
Yeah.
The labor market is just booming. I mean, it's surprisingly resilient.
Jason, they say don't fight the Fed on the way up. I would also not fight the Fed when they're literally trying to break the labor market. Like if you ask Powell, he goes this close to say that he wants to see people unemployed.
Oh, I know.
Because, literally. So this is an institution that is looking to weaken the labor market. And generally, the Fed historically ends up over-tightening. They think the economy can handle a lot, and they always end up stepping on something, right?
Got it. But maybe, and especially with the 3 bank failures, maybe they are now thinking we've already over-tightened. Even though inflation is still high, we're just going to have to accept it. I mean, I love memes because memes say a lot in a small space.
Sure.
And here's the meme that you've probably seen, right? Which button does the Fed push? Do they push the runaway inflation button, or do they push the banking system collapse button?
Yeah. I mean, look, the issue here for Powell is credibility. And we talked a bit about this before the show, and I think it's really relevant because a central bank without credibility is lost. I mean, people think that QE or QT or interest rates are the biggest tools of a central banker. That's not true. It's credibility. Because if what a central banker says is not listened by markets,
right,
everything's going to try to do is just useless, right? So talk about credibility. This is the same guy, Jason, and 3 days ago went to the Senate testimony and he literally said, interest rate cuts, what are you talking about? The labor market is strong. I mean, he was asked some very strong questions like, dude, look at the past. And I mean, if you want to bring inflation down from 9% to 2%, you need to generate a recession. Is that what you want? Like, yeah, I don't want a recession, but if this is the price to pay, we're talking about that kind of guy. And from a credibility perspective, I think I don't know if he's ready to give in, but the risk he runs is that he keeps tightening here to maintain this credibility until something really breaks. Because now he has managed to break the following. A couple of regional banks, the first large default on a commercial mortgage-backed security by Blackstone and KKR gating the redemptions on real estate investment trusts. That's what he's managing to kind of freeze or break so far.
Right.
Now, I don't know if it's enough for him. Probably not, for a matter of credibility. He's really obsessed.
By the way, Blackstone had kind of the equivalent of a run on the bank themselves,
Pretty much,
right?
It's exactly the same.
So did KKR, yeah.
I love this analogy. It's the same. Yeah. You have investors saying, I'd like my money back, please. I don't like this real estate investment trust anymore. And Blackstone goes like, nah, I'll give you 5% every quarter. Yeah. So basically, it's like locking people away from their bank account. Like the same thing. Because you don't want to sell your collateral. You don't want to have to liquidate these offices, these stores, these houses in this market. So I don't know if he's going to pivot already. I don't think he's ready for that. But what I'm pretty sure about is that if he keeps going like that, in a few quarters, he'll have to break something much bigger. So it's just a matter of when.
I just want to remind you, though, Alf, let's not talk about 3 days ago. Let's look at a year and a half ago.
Yeah.
And Jay Powell seems like, I don't know when his birthday is, but he must be a Gemini, because that's the sign of the twins, because he has got a split personality. During the COVID era, he was the most dovish guy. He was like Alan Greenspan times 10. We're going to ease the money supply. We're going to pump the system, helicopter money, Ben Bernanke, whatever you want, we're accommodating you. We're going to make sure the system does not seize up with COVID. And the money just, money printer go burr, right? Then he became like the reincarnation of Paul Volcker all of a sudden. The guy is just, I don't know. And he might swing back.
It's not about what they should do, I think, when you're an investor. It's about what they will do. That's what I learned. So you need to try and put yourself in their head and think, what is the risk reward here for Powell? What's his incentive scheme? Well, I think he wishes that we get a soft landing, and this is an idiosyncratic episode, and then he can keep hiking a bit until inflation cools off, and then magically we get inflation back to 2%, but nothing bad happened. I think we're getting the first signs that this is a very difficult exercise to engineer.
Oh yeah, they're in a corner. The Fed they have just screwed this up so badly. They should have tightened sooner and more slowly. And they could have had a soft landing, but Powell he believed in the transitory thing for way too long.
Unfortunately, that was the case. And so that also created some incentive schemes for some of these banks, for instance, that doesn't justify no risk management, that doesn't justify the moral hazard, right. But they were basically promised that there would be no hikes for a year, 2 years, 3 years, 4 years. These all created distorted incentive schemes, including tech companies being IPO'd at 100 times earnings. That looks like a while ago, but with negative real interest rates, any investment might make sense. You're discounting future cash flows down in the future with a negative interest rate. Anything might make sense at that point, right? And I think these incentive schemes are now coming to haunt us a little bit. On the other hand, I don't think he has really much choice for the time being, because you said it. Imagine the guy now really pivots. Let's make a mental experiment. He does that and he says, we are done. We just do 25 basis point now. We are done. That's it. What happens? The dollar craters, gold goes up, inflation expectations go up, real yields go down. You still have inflation running at 5%. Yes, it might be a bit cooler down the road, but you are really risking it big here, because you're far away from achieving your target and you're letting everything inflationary happen. So can he run that risk already? I don't know. But as you said, that meme says enough, right? In a very short span of attention time.
It does. Before you go, Alfonso, I just want to ask you, because we were talking about the housing market, of course, that's super important to our listeners. And I want to show you this chart. And you alluded to basically this idea earlier. And I think this is a critically important chart. It shows you the existing mortgages in the U.S. Yes. First off, 40% of the homes in the U.S. have no mortgage at all. Okay. But of the existing mortgages, about 25% of them are below 3%. 65% of them are below 4% in interest rates. These people have 28 to 29 years left on these mortgages.
Correct.
How are they going to get into distress? One of the things I always say is if you want to have a housing crash, you must have distressed sellers.
Correct.
And if you look at inventory, inventory is about 40% of normal. There's very little inventory because these resale homes that are would-be sellers, they're just not going on the market. There's just no urgency.
So,
the people are remodeling their kitchens, they're improving their house, they're putting a new coat of paint, nicer landscaping. They're just staying put. And they just have an incentive to stay.
I really get this point, and distressed sellers is the key. I mean, if you don't find these, then the 20-30% house prices decline projections that you see sometimes now, they're not going to realize. I invite people, though, to pay attention to institutional investors in the real estate space, because you're talking about families, and you're totally right there.
Right.
But don't forget that between 2014 and 2021, interest rates were so low that a lot of pension funds, asset managers, banks, they ended up buying all these leveraged real estate products, and they have different incentive schemes to sell them out, right? If they feel stress, if they feel that they need to monetize, they could be the one that actually start potentially a cascade. So I'm more worried about them. I'm more worried about KKR and Blackstone and the banks and the pension funds and the asset managers than families in America selling. Why would they sell? They only sell if the labor market really goes sour and then they need some money. But the real problem is the institutional investors. They've piled up in there is no alternative kind of investment atmosphere of 2014, 2021. Those are the risk, I think.
Well, fair enough. But yes, the institutional investors, compared to the past, are a bigger player than ever. But compared to the size of the whole housing market, or even the rental housing market, they're like a bucket in a bucket of water in the ocean. It's nothing.
And again, you're right. That's a smart consideration. It's just about the specific period in time. If you get distressed sellers at the moment when affordability is a bit more tricky than it has been in the past, you get a bit of that air pocket. This is the risk that I see. A moment where distressed sellers come to the market with a lot of supply, all of a sudden to be absorbed. And exactly at that point in time, the elasticity of buyers is not there to absorb it. That could be the risk if you want to depict one.
Okay, so they would be shooting themselves in the foot, though, to some extent, if that happened, because they'd be lowering the price of their own inventory.
Yes.
If they didn't dole it out slowly, which is basically what happened during the Great Recession, right?
That's true.
There was a lot of pressure from the government, because they were doing the bailouts and the TARP program, to say to these banks, look, you must release this inventory slowly. And that didn't exactly happen, but there was a lot of talk about it, but it didn't really happen.
So look, again, Jason, it's incentive schemes. Like, these guys would be shooting themselves in the foot, but the reality is, if they're urged to sell by the risk manager, by whatever it is, they could be distressed sellers. But you're right in principle on your observations.
I think the key is, and this I do not know, you probably do, what type of capital stack do they have on those properties? What is their debt structure like? I mean, do they have a bunch of 3% and 4% 30-year fixed rate mortgages, these institutional investors? Because if they do, their incentive will be to hold. But they probably don't have that great, type of financing that the homeowners have. What do they have? What is their debt?
Yes. I mean, the issue is, if you were looking for yields, you went and bought the lower tranches of these packaged real estate products. That doesn't mean you bought, the garbage, but you bought stuff with higher loan to values, with worse mortgage rates behind, because those were the ones that paid you off more as an investor to buy, right? So again, and it's also like a bit of the accounting and the visibility kind of problems. If you think the housing market is freezing, you don't want to show to your investors that you're loaded up on highly leveraged real estate products. It's really a matter of, as well, incentive schemes. I mean, the family, as you said, doesn't have any incentive scheme here to sell. I mean, why would you?
So the family's going to stay put. Yeah.
I think so, unless the labor market cracks. But the institutional investor might have other urges that are not driven by this kind of considerations.
Yeah, very interesting. Very interesting. Alfonso, we really appreciate you coming on such short notice. What else do you want to say before you go? Just wrap it up, give out your website so people can subscribe to your newsletter, et cetera.
Thanks, Jason. Very kind of you. So what I would say is, look, the situation is very fluid. There is a lot of uncertainty with this banking crisis and macro out there. I've been lucky enough to be in the trenches and have done that job for 8 years. And now I run an independent research company and portfolio strategy company called the Macro Compass. I'm going to work hard to make sure I deliver as much insights as I can in this very uncertain and fluid macro situation. If you guys want to check it out, it's on themacrocompass.com.
Excellent. Alfonso, thanks so much for joining us.
Thanks, Jason. I appreciate it.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.